Hello, this is Will Allen with Centera Capital. I hope you had a great 4th of July. I can't believe we are in the second half of 2021 already, but we are. And today we are going to take a deeper dive at the recent decrease in interest rates as well as changing leadership in the stock market. Let's go. During the first 3 months of 2021, one of the most significant developments was the increase in interest rates for U.S. Treasury bonds. And specifically, the 10-year bond went from a yield of less than 1% coming into the year up to 1.78% at its peak in early April. That was a fast move of that size, and certainly led to some market volatility. In the last few months, though, rates have started to come back. And as we talk today, the 10-year is at 1.37%, still a good bit higher than it was coming into the year, but that's a pretty major pullback from where we were just a few months ago. And that has been positive for equity markets and positive for bond markets. Remember, when interest rates move up quickly, bond values decline. And so that's something that you have to be careful of when we're managing your bond portfolio. Alongside of that move lower in rates, recently inflation expectations have started to cool just a bit. Now, don't get me wrong, most of the inflation data coming out continues to be white hot, but the Federal Reserve is still sticking to their forecast that this is going to be transitory, a few more quarters of hotter inflation numbers, and then that will start to dissipate and we'll go back towards long-term trends. It's way too early to know exactly how that's going to play out, but things like, for example, in the last 6 weeks, the price of lumber is down 65%. It's now lower year to date. That's after it had just exploded to the upside. Copper prices are also down about 25% in the last 6 weeks. So a lot of commodity costs have fallen back. It doesn't mean they can't turn around and go higher, but that's helped bolster the Fed's argument that inflation is going to be more transitory. Now, I will say this. A lot of times commodity prices have very boom and bust cycles. So prices for lumber skyrocket and then suppliers go out and do more harvesting and come up with more lumber. And then therefore you get oversupply and then prices, plummet. That happens frequently. Now on things like wages, for example, that's not the case there. And so wages, housing, those are going to be important things to watch over the next 6 months to a year, because if we get significant wage pressures and housing continues to go up at the clip of 10, 15, 20% a year, that's going to be a lot tougher for the Federal Reserve. And that'll put them in a position where they're going to have to move sooner than they want to with regards to reducing their bond purchasing and eventually raising interest rates. Why that matters to you, the outside of the coronavirus market meltdown we saw last March, the biggest market decline in the last 10 years was in the fourth quarter of 2018. What prompted that was Jerome Powell, who was Fed chair at that time, and he still is today, at a conference mentioned that there were going to be multiple tax hikes in 2019, and this caught the market a little by surprise. And you had a major sell-off ensue. The S&P was down about 20%. Other parts of the market were down about 30%. The market bottomed on Christmas Eve. A week later, the Fed started to walk back tax hikes in 2019 and in fact decided we're probably going to have to cut rates in 2019. The market loved that and the market was off to the races. So how the Fed communicates over the next 6 months about what they're going to do, and depending on where interest rates go, what is happening with the inflation numbers, all of those things are going to work together and be a big determinant of what kind of market environment we're going to get. Now let's talk a little bit about some of the changing market leadership on the stock side. For the first 4.5 months of the year, the stock market was led by what we call the reopening trade, which is banks, energy, industrial companies, travel companies. These are all businesses that in 2020 were really hammered by the shutdowns from COVID. But what we have seen, a shift started in mid-May, where a lot of the growth stocks, a lot of the tech companies that had done really well last year and had lagged significantly earlier in this year started to get the baton, if you will. We got the Summer Olympics starting here in about a week or so we'll pay homage to that. But the baton was passed, and of late we've seen tech and growth really make up ground. And you can see on this chart here, this is the QQQ, a tech ETF, compared to RSP, which is an S&P 500 equal weight fund, which basically you're looking at the average company in the S&P. And you can see that the equal weight fund is still higher on the year, but the gap has been closed in the last 6 weeks. The good news is that this really is pretty healthy for the markets. We have seen what I would call a rolling correction in the first 6 months of the year. We haven't had the market have a significant sell-off, but parts of the market have had sell-offs, and when they have been, other parts have been holding it up. And that extends outside of certain asset classes. That even could extend to something like cryptocurrency, which was, peak enthusiasm for cryptos several months back. In the last 2-3 months, Bitcoin's down 50% from its high, Ethereum's down about 60%, Dogecoin is down over 70%, but yet they haven't taken down the markets. And so it's going to be important here in the back half of the year if we can continue to have kind of rolling corrections of certain segments of the market while others are showing strength. That could really go a long way to minimizing any larger declines. With all that said, it's going to be an exciting third quarter for the markets. One date to note, in late August, the Fed has their annual conference in Jackson Hole, Wyoming. That is going to be closely watched, every speech there, for any hint on what the Fed may do or any changes that they may communicate to investors. And so between now and then, we'll be closely watching interest rates, closely watching the inflationary data, because again, any numbers outside consensus in those areas can lead to sharp moves in the markets. We're in the heart of earnings season right now. The next 2 weeks are the biggest 2 weeks of the quarter. We expect that earnings are going to be very, very good. Growth rates for the market in general over 60% over last year. So there's going to be a lot of positives there, but we're going to be closely watching the markets to see if any of these things change, and we hope you have a good day. Thank you.